Okay, in today's lesson, we are going to look at one very important topic in accounting. It's basically on depreciation, and is a method of calculating depreciation. It is called revaluation method. Revaluation method. When you want to calculate depreciation, there are methods that can be used. We have different methods that can be used depending on the nature of the organization and the policy of the organization. We have the likes of straight line method, reducing or diminishing balancing method. We have the disposal of asset method. We have the sum of the A-digit method, and so on and so forth. But today, we want to single out revaluation method and see how we'll be able to explain this method and describe this method in such a way that students can differentiate this method from other methods. And we're also going to demystify the method and expose the focus of the examiner in any examination that is based on accounting. So I would like us to first of all look at what we call the lesson objective, those things that will serve as a focus of our journey in today's lesson. Number one, we are going to describe revaluation method. We are going to state the formula, and we are going to solve related problems and post provision for depreciation to the necessary account. Then at the end of the lesson, there's what we call success criteria. What we will use or we can use to measure our level of success. Number one, if at the end of the lesson we are been able to describe revaluation method, we've been able to state the formula, and we've been able to solve related problems and post provision for depreciation to the necessary account, then we can say we have achieved the objective of the lesson. Now let's look at it. When we talk about revaluation method, how is revaluation method different from other methods of calculating depreciation? What are those parameters that one needs to understand about revaluation method? In what way is it different from other methods, the likes of straight line, diminishing balance method, sum of the A-digit, disposal, depletion, or amortization? Now, number one, we said that by this method, like by revaluation method, the asset is revalued each year. Any difference will be charged as what? Depreciation. You see, it is very, very unprofessional, and it is not prudent enough for a company to use an asset over a period of time without revaluing the asset, because asset can either drop in value or asset can either rise in what? In value. There are some assets that, as the society is changing, the economic environment is changing, the asset can either appreciate or depreciate. For instance, if you have a plot of land, in 2023, if that plot of land is with you in 2026, 27, you will see that the cost of that asset in 2023, it will not be the same thing with the cost of the asset in 2025 or 2026. You will see there must be an increase. So that value of asset must have appreciated, because you cannot sell it as an amount that will be less than the way you bought it. So there are assets that need to be revalued. So when you are going to adopt the revaluation method, you are going to revalue that asset after a period of time. And then the difference between the value of the asset and then the revalued cost is what will give you the depreciation. We said it is good for assets like loose tools, like hammers, chisels, spinels, livestock, and so on and so forth. There are assets that if you leave them, they look like they can stay for eternity, because these things are actually metallic in nature. They barely rust, or they barely depreciate. You cannot ascertain the physical deterioration. You can't ascertain the physical wearing away of the asset because of their nature, their texture, and their formation. But what we usually do is that we have to reconsider their value, compare what it is with what is obtainable in the market. And then the difference will now become the depreciation. We said the value of the asset at the beginning and the end must be what? Must be known. Now, there is one fundamental truth that I want to establish here. Every asset, no matter how strong that asset is, companies should be able to predict the lifespan of that asset. Even humanity, there is nobody that can live forever. For the Christian faithfuls, we know that the highest you can live, the highest 140. If not, by 80, 90, 20, that's what we call life expectancy. At a certain level, it is expected that you begin to grow old. That's the same way asset in an organization can also be old. So organizations should not just buy asset and begin to use it without a prediction of the number of years that asset can last in the organization. So when this is done, you must compare the cost of the asset with the value at which you can sell that asset at the end of the asset's useful life. Now, when we talk about the formula, how to calculate the formula for revaluation is a very simple one. First of all, you determine the cost of the assets and then add any other asset that is procured within the period and then subtract the revalued cost. What do I mean? Let's illustrate this very quickly on the board. We said that, first of all, the cost of the asset. Cost of the asset plus additional what? Additional asset minus the revalued. The revalued what? Cost. What do I mean? If, for instance, I bought an asset for, let me assume I bought an asset for 20,000, and then in the process of carrying out the business, there was need to buy an additional asset of 15,000. And then maybe at the end of the period, these two assets, now when you add this to this, you have 35,000. If at the end of the period, I decide to sell this asset at the rate of 20,000, this is what we call the revalued cost. This is what we call the revalued cost. So to get the depreciation, you're going to subtract this 20,000 from here, and you'll be left with what? 15,000. This 15,000 is what we call the depreciation. It's called the depreciation because between the 35,000 and 20,000, there is a 15,000 naira what? Difference. So that difference is what we call the depreciation. Now, I said if the valued cost is less, like what is obtainable here, 20 is less than what? 35,000. The difference becomes the depreciation, which is the 15,000. This depreciation can be called revaluation deficit or downward revaluation. Now, when you talk about revaluation deficit, we are talking about a period where the revalued cost is less than the cost of the what? Asset. It is called deficit or downward revaluation. However, if the revalued cost is higher, like for instance here, instead of us to sell it at 20,000, we now sell it at what? 50,000. If we now sell it at 50,000, at this point, the difference is still 15,000, but this is revaluation surplus or what we call profit. The difference between both of them is called what? You can either call it profit, revaluation surplus, or what we call upward revaluation. This is basically unique with land. There are some properties that, as time goes on, they begin to increase in value. Example, land. Example, another one is investment. Investment is also an asset. Investment in other organization. You can put money, you can decide to invest in another organization. As time is going on, you can always revalue your investment. And what you call increase in price, inflation can actually make your investment to either fall or it can also rise. So that's how far we can go with the formula of revaluation method. Let's quickly look at an illustration that will help us to understand what we are talking about. Now, let's look at what is on the board. We said that on the 2nd of January 1990, the value of loose tools was 98,000 naira. On 29 June, new tools were bought for 45,000. On 31st December 1990, they were revalued at what? 78,500. Show the lose-tools account using the revaluation method. A very simple question that if students don't understand, it can make you to, it can frustrate you in the examination hall. First of all, ask yourself, what do we have at the beginning of the period? We have, at the beginning of the period, we have what? 98,000. This is the value of asset we have. They said on 29 June, new tools were bought for what? 45,000. Now let's add this together. 98,000 plus 45,000. Let's quickly use our mathematical set. 98,000 plus what? 45,000. What do you have? You have 143, 123. Now this is the value of the asset we have in stock. We have 143,000. Now they don't said that on 31st December 1990 they were revalued at 78,500. So now the revaluation cost is what? 78,000 what? 500. So your depreciation right now is going to be equal to 143,123 minus what? 78,500. So let's look at it together with our mathematical set again. We are 143,123 minus what? 78,500. 78,500. The answer is 64,500. So your 64,500 is the depreciation. Very simple. 64,500 is your depreciation. But look at the question. They said you should show the lose-tools account using revaluation method. That's what they asked you to prepare. They didn't say you should point out the depreciation. They only say you should prepare the what? The account. So having arrived at 64,500 as the depreciation, what you simply need to do, let's prepare the account. Let's quickly write this somewhere so we will not forget. 64,500. That's our depreciation. So we can do away with everything on the board and take our time to prepare the account. You call it loose tools account. Now, loose tools account is an asset account. So it must come with a debit balance. So what is going to happen here is that the balance from the beginning, you have your balance brought down. That's the value of the asset at the beginning of the period. We said on 2nd of January, that was when they started the business. The value we had was 98,000. So you have your 98,000 here. And then in the period, we bought what? We bought another loose tools for 45,000. You come here, you write your cash, 45,000. And then, this is what we have achieved. So, now on the credit side, this credit side, we're going to consider two things. First of all, remember this is our depreciation. But before you get to this value, let's assume that our balance now, balance carried down, is going to be that value at which you sold out the item, at which you sold out the asset. What is that value? Is 78,500. So you have 78,500. So your depreciation is simply going to be here plus here minus here. So you are going to have here plus here minus here. This is what you have, and this is what you have at the end of the period. So your depreciation is this plus this minus this. We have done that before, and we said it's 143 post 0, 143 post 0, and then when you subtract here from here, you're going to have that 64 what? Let's confirm it's 64,500. Don't forget your Naira sign. So this is how it will look like. And then your balance brought down is going to be what? 78,500. 500. So this 78,500 is what is going to be in the account of the company as a value of loose tools for the subsequent year. So that is how to prepare. Now, you have prepared the loose tools account. You have the value of the asset on the debit side. This is what you have at the beginning. This is what you've been able to buy in the process. When you add this to this, you have 143,000, which is 143,000. And then you are able to sell, you're able to revalue it at the end of the period, 78,500. So the difference between this and this will give you the what? The depreciation. The depreciation here is what we are looking for. This is the depreciation we are looking for. This is how to use the revaluation method to calculate depreciation. Let's quickly see how we can represent this in the 4 account. Now we have prepared the loose tools account, which is the asset account. The next account that I feel we should also prepare is what I call the profit or loss account. So if you are preparing the profit or loss account, you are preparing the profit or loss account. Simply write your profit or loss account. Now, don't forget that your profit or loss account is an extension of your trading profit or loss account. This is the part of your trading profit or loss account that deals with the expenses incurred within the period. As a matter of fact, we are looking at depreciation. Depreciation is just a segment or a part of the expenses that one can incur in the process of carrying out a business. Now, in the account doesn't look empty like this. There are other transactions that has to come in if you want to prepare a comprehensive or an extensive account. But since it's just asset account we are looking at, we just want to single out the depreciation. So right now you are going to write here, the year is what? 1990. And then the depreciation is going to be what? Depreciation is going to be what? 64,500. That's the depreciation. This is how it will look like. If you were preparing a full profit or loss account, other expenses will now be added to it, like salary and wages, furniture, electricity bill, you have rent, you have bad debt, you have salesman salary, and so on and so forth. All of those expenses will now be added to this to make up a full account for expenses. Now, once you are done with this, the next one is what we call provision for depreciation. Provision for depreciation account. Provision for depreciation account, the same thing. You have the year here, 1990 here. And then you have your profit or loss here is going to be 64,500. And then you come here, you write 1990, and you have your balance carried down, 64,500. And that will be it. So that is how to prepare it in the provision for depreciation. Now you see that this value is credited on the depreciation for provision for depreciation, why it was debited in the profit or loss account. You can see now that profit or loss account is given as a description of the transaction here, while when we were preparing profit or loss account, depreciation was the description. So you see anytime you are preparing account, you will not always forget the double entry principle that states that for every debit entry, there must be a corresponding credit entry and vice versa. And then the last but not the least is the balance sheet. The balance sheet, which is the same thing, you have the year is 1990, and then you have your two values here. You have the asset is what? Loose tools, LT. Let me write it in full. And then loose tools. We have 1, 4, 1, 4, 1, 4, 3, 1, 2, 3. That's the cost. And then the depreciation is 64,500. Then the net book value now is that value at which you are going to get. So you have 78,500. So that is how to prepare it now. You see the loose tools, the value is 143,000. And then the depreciation is 64,500. When you subtract this from this, you're going to get the value that is given to us in question as the revalued cost of the asset. So far, so good. I have said earlier that the balance sheet is simply a statement, it's not an account that will show you the position of your assets and your liabilities. All right. Having done that, can we quickly go to our exam guide to see if we'll be able to get something that can further explain or bring the message home? When you open your exam guide, you see subjects displayed on the screen. It's already take account stick because that's a subject of interest, and then you can choose your year. At this point, we are choosing random because we just want to get all the questions that can be set within the period, within the topic we are looking at. But we recommend that students should choose any year of interest, and then you choose the topic. After you have done that, you can click on Get Started, and the necessary questions will pop up. They said that the method of charging depreciation at a fixed percentage of the net book value is number 1, sum of the year digit method, revaluation method, reducing balance method, straight line method. The answer is sum of the year digit method. Sum of the year digit method is the only method where depreciation is charged on the net book value of the asset. And then let's look at number 2. We are going to look at something. Okay, let's see this. They said that the purchase price of equipment is 60,000. The freight and installation cost is 10,000. Annual maintenance cost is 1,000. They said estimated useful life is 5 years. The estimated scrap value is 2,000. What is the annual depreciation of if straight line method is used? You know, straight line method is a method that uses the same amount of depreciation all through the useful life of the asset. I will recommend that students go to our videos and look at this. But let's just look at it. There's something I want to point out in this question. The cost price of the equipment is 60,000. Cost price is what? Is 60,000. And then the next one is the say freight and installation. Let's just take it installation. Installation cost is how much? Is 10,000. And then maintenance. Maintenance is what? 1,000. And then residual value. Residual value is what? Is 2,000. And then useful life is 5 years. Now what you are going to do is this. This value is a distraction. Maintenance is a distraction. Why I call it a distraction is because it is an expense that cannot be capitalized. In a business, there's what we call a capitalization of certain item and the expense of an item. An item can be capitalized when the value is big enough to affect the value of the asset. But if the value is not big enough to affect the value of the asset, such a value can be what? Can be expensed. So in this case now, we said cost price is 60. They say installation cost. The cost involved in storing the asset must be added to the cost of the asset. You can't buy AC, air conditioner, and then you put it in your house and you will not consider the cost of installing it. There are some assets that when you buy it into the company, the cost of installation must be part of the cost of the asset. So here in this case now, the cost of the asset is what? 70,000, which is 60,000, 60,000, plus what? 10. So the cost of the asset is what? 70,000. Now, if the cost is 70,000 and they are saying that the residual value is what? 2,000 and the useful life is 5,000, let's just apply the formula of straight line method, which says cost minus residual value all over what? Useful life. Useful life. We will now have 70. Let's now write it. This is the formula. Let's now write it. We have 70 minus what? Minus 10. 70,000 minus 10. And then divided by what? 5. 70,000 minus 10. This is going to give you 60,000 divided by 5. So when you do 60,000 divided by 5, 60,000, 1, 2, 3, divided by 5, you are going to have 12,000. So 12,000 naira is the value of the, as I say, what is the annual depreciation charge? If straight line method is used, the annual depreciation charge is what? 12,000, which is D. All right, so far, that is how much we can take for today's lesson on revaluation method. We recommend that students should go back to the previous videos and get familiar with other methods of calculating depreciation. So they will not be frustrated when they will not be confronted with other methods. We have done straight line method, reducing balance method, and now we have looked at revaluation method.